What if there was a way to protect your portfolio while still making steady, consistent profits every single month? Most people think you either have to choose between growth or safety. But with the right strategy, you can actually do both. In today's video, I'll show you how to use covered call to generate passive income, cushion your downside risk, and build wealth over the long term. Here is what we are going to cover: the basic of covered call and how they work, why they are especially powerful in today's market environment, how to choose the right strike price and data, when to open and close the trade, how to roll a covered call to extend profits, and finally, real example using Palantir, Nvidia, and other high volatility stocks. Stick around until the end because I will also share my personal mindset on using this strategy to grow my portfolio steadily without taking on reckless risks. Section 1. What are covered call? Let's start with the basic. A covered call is when you own 100 shares of a stock and then you sell a call option against those shares. Why do this? Because when you sell a call, you immediately collect a cash premium. That premium acts as an income. You are getting paid just for owning the stock. The downside cushion: if the stock drop, that premium reduce your losses. Think of it like renting out a property you already own. You own the property, but you also collect steady rental income every month. Section 2. Why covered call works best now? Covered call are always a solid strategy, but they are especially powerful right now. And here is why. Stocks are at all-time high. When prices are elevated, the risk of a pullback is higher. Volatility is elevated. And when volatility is high, option premiums are richer. That means you get paid more for selling calls. Uncertainty is rising. With potential market pullback, having a built-in buffer protects your portfolio. So instead of just sitting on shares or hoping for the best, you are actively generating cash flow from your position. If you are looking for a broker to start investing, check out Tiger Broker Singapore. They are user-friendly, offer responsive customer service, and make the trading journey much smoother, especially if you are just getting started. And here's a bonus. If you use my referral link and deposit at least 1000 USD and complete just one buy trade, you'll receive USD $5 worth of Tesla stock. This is a brokerage that have simple steps, quick rewards, and a great platform. You will find my referral link in the description below. Feel free to check it out. Now, let's use Palantir as a real example. The stock has been on fire, up over 140% year to date. But when a stock rally this much, this fast, momentum eventually cool down. So here is what I will do if I own 100 shares of Palantir at around 150. I would sell a 160 strike price call option expiring in about 30 days, collect around 800 in premium for every 100 shares. There is around 4% return in just 1 month. Here is the beauty. If Palantir stay flat, you keep the $800. If it drops, that premium cushion your downside. If it rises to 160 or slightly above, you still profit, but you cap your upside. Either way, you win. So, how do you actually pick the right strike price? This is where delta comes in. Delta is basically the probability of an option expiring in the money. For covered call, I like targeting the 30 to 40 delta range. That means there's about 30% to 40% chance the option finishes in the money, and a 60 to 70% chance you simply keeping the premium and your shares. And that is the sweet spot. You collect a strong premium while still giving your stock some room to run. Another key factor is implied volatility, or IV. The higher the IV, the richer the option premium. For example, Palantir right now has implied volatility in the mid 50s. That is high. When IV is high, you get paid more for the same trade. This is why stocks like Tesla, Nvidia, or Palantir are great candidates for covered call. They are volatile, which means consistent premium income for you. Now let's be clear. Covered call aren't risk-free. The biggest trade-off is this. If your stock skyrocket way above your strike price, you cap your upside. For example, Palantir suddenly jumped to 200 in a month, you will be forced to sell at 160. You will still profit, but not nearly as much as if you have just hold the stock. But here is the mindset shift. Covered call are about consistency, not chasing every last dollar. They work best when you are happy to sell your shares at the strike price or at least comfortable capping some upside in exchange for guaranteed income. Let me give you another real world example, this time with Nvidia. I sold an in the money call option at 170. Nvidia shot up to 183. Yes, I kept some upside, but overall, I still walk away with thousands in profit. And that is the power of this strategy. If you lose by capping gains, you still end up making money. And you are doing it with lower risk. So what happens if your covered call get close to being in the money and you don't want to sell your shares? That is where rolling comes in. You simply buy back your covered option and then sell another one further out in time or at a higher strike price. This let you extend the trade, collect more premium, and keep your shares. It's a great way to stay flexible while continuing to earn income. At the end of the day, covered call are not about quick wins. They are about creating a reliable, repeatable income stream from your portfolio. Think about it in this way. If your portfolio is 50,000 and you can generate 2 to 4% a month, that is 1,000 to 2,000 in cash flow. Scale that up to 500,000 or even $5 million, and you are talking about life-changing income enough to retire comfortably. The real power of covered call is longevity. You are not taking wild bets. You are compounding your portfolio steadily over time. So to wrap this up, covered call let you turn stocks you already own into income producing asset. They reduce downside risk and give you a consistent cash buffer. They are most effective when volatility is high and stocks are stretched at the top of their range. If you are serious about building wealth long term, this is one of the most powerful strategy you can add to your toolkit. If you find this breakdown valuable, hit the like button, subscribe, and turn on notification so you don't miss future videos. Thanks for watching, and I'll see you in the next one.